You probably think the frightening part was the crash. It wasn't. The frightening part was what fell with it. Stocks sank, oil sank, industrial metals sank, even gold, the thing people treat like a lifeboat, got dragged under. If you want a channel that follows the hidden wiring of the market instead of the shouting on the surface, hit subscribe now, because this story gets stranger the deeper you go. In less than 2 trading days, trillions of dollars in market value were wiped away. The fear gauge exploded, screens turned red everywhere, and the big question was not why risky assets got hit. That part is easy. Panic always punishes risk first. The real question was why the so-called protection assets failed at the same time. Why did the shield crack when people reached for it most? Most people heard the same lazy answer. Investors hate uncertainty. Tariffs created uncertainty, so markets sold off. That sounds smart until you lean on it for more than 10 seconds. It explains mood, not mechanism. It names the smoke, not the fire. Because if uncertainty were the whole story, you still would not know why gold dropped, why commodities rolled over, or why the selling spread so fast through everything at once. Markets are not just emotional crowds. They are also giant pricing machines trying to guess the future. Every stock price is a rough bet on tomorrow's profits. Every commodity price carries a guess about demand, supply, growth, and money. And when one policy shock hits all of those guesses at the same time, the damage does not stay in one corner. It spreads through the entire system. Start with the simplest part. A tariff is just a tax placed on goods coming in from outside the country. People argue about whether that tax is wise, fair, strategic, or overdue. But before any of that, it is still a bill. Someone has to swallow the cost. And the most important part of this whole story is that the bill usually does not stay overseas. A large chunk of it lands at home. That matters because many people picture tariffs like a punishment aimed neatly at foreign producers. They imagine factories in another country cutting prices and taking the hit. Sometimes a small piece of that happens, but not most of it. In the real world, importers pay more, businesses pay more, and shoppers pay more. The extra cost moves through the system like a leak in a pipe, showing up in thinner profits, higher prices, and tighter household budgets. Think of a family already juggling rent, groceries, gas, and credit card payments. Now imagine everyday goods quietly getting more expensive across the board. That family does not need a recession speech from a banker to change behavior. They delay purchases, they skip upgrades, they cut back. And when millions of families do that together, company sales soften, which means the market starts lowering what it thinks those companies can earn. If you like market stories that answer the bigger question instead of the loudest one, subscribe here, because the next layer is where the whole thing turns from ugly to dangerous. Once costs rise and spending power slips, businesses get squeezed from both sides. Their inputs become more expensive while customers become more cautious. That is a brutal combination, especially for companies already running on tight margins. And when future profits get revised lower across large parts of the economy, stock prices do what they always do. They move down to meet that colder reality. So no, the market did not just wake up moody. It started repricing an economy that suddenly looked less efficient and less profitable. Factories cannot swap supply chains overnight. Retailers cannot magically replace inventory sources in a week. Logistics networks built over decades do not pivot on command. When trade rules change fast, the economy does not respond like software. It responds like a giant machine, grinding, stalling, and wasting energy. Now add the second blow. Tariffs do not just slow growth, they can also push prices higher. That is the part that traps policymakers, because now you have an economy that may be cooling at the exact same time everyday prices are staying hot. That condition has an ugly name: stagflation. It means life gets harder even before the economy fully breaks. Stagflation is nasty because the normal rescue tools stop working cleanly. If the central bank cuts rates to help growth, cheaper money can feed inflation. If it raises rates to fight inflation, borrowing gets more expensive, and the slowdown can get worse. Either move solves one problem by worsening the other. It is like trying to put out a kitchen fire while the water line and the power line are both exposed. Every choice carries damage. For years, markets lived with a comforting belief. If things got bad enough, the central bank would ride in and support the system. Rates would come down, liquidity would rise, risk assets would breathe again. That belief became part of investor muscle memory. Buy the drop, hold your nerve. Help is coming. People stopped treating rescue as a possibility and started treating it like a habit. But habits break when inflation stays stubborn. A central bank cannot easily rush in with easy money while prices are already climbing. That old safety net starts looking thinner. And when investors realize the friendly referee may not stop the fight this time, the market does not politely adjust over a few calm weeks. It lunges lower all at once. If you've ever wondered when a sell-off becomes more than a sell-off, this is the moment to subscribe, because this is where the crowd stops reacting to headlines and starts confronting a changed rule book. The rule that changed was simple. People no longer felt sure the usual rescue would arrive on schedule. That shakes confidence far beyond one news cycle. It hits the hidden assumptions buried inside thousands of trades, from pension funds to hedge funds to ordinary retirement accounts. Now we can come back to gold, because this is where people get confused and start saying nothing makes sense anymore. They think safe assets must rise the instant fear rises, but that only happens when investors are choosing calmly. In a forced unwind, people do not sell what they dislike, they sell what they can. That is a huge difference. A gold bar in a vault does not care about a two-day panic, but many investors do not own gold in that simple way. They own paper products, funds, futures, and leverage trades tied to gold's price. Leverage means borrowed money. It makes gains faster on the way up, and it makes pain much faster on the way down. When gold runs hard for a long time, plenty of traders get bold. They stop seeing it as insurance and start treating it like a fast-moving trade. More money piles in. Some of it is borrowed. Some of it sits inside products that must rebalance every day. That works beautifully when prices keep climbing. It becomes a machine of automatic selling when prices start slipping. Here is how the trap springs. Gold dips. Leverage positions lose value faster than normal. Brokers demand more cash or more collateral. That is a margin call. If traders cannot post more money, positions get cut. To raise cash, they sell whatever can be sold quickly, not just gold, but stocks, oil contracts, industrial metals, almost anything liquid. That is why panics often look irrational in real time. It is not that every asset suddenly became worthless. It is that the system started demanding cash immediately. And when cash becomes the only thing that matters for a short window, even good assets get tossed overboard with bad ones, like passengers throwing food, tools, and maps off a sinking boat just to stay afloat another hour. So when gold fell with everything else, it did not automatically mean the long-term case for gold was dead. It meant the short-term market was dealing with forced selling. Price and value are not the same thing in those moments. A desperate seller can drag the sticker price down far below what the asset may be worth over time. Fire sales are not clean votes about the future. They are emergency exits. This is also why people get hurt by reading every market move like it is a wise statement. Sometimes the market is thoughtful, sometimes it is mechanical, sometimes it is studying the horizon, sometimes it is just meeting collateral calls before the bell. When fear and leverage collide, correlations jump, things that should move differently start moving together, not because they became identical, but because the plumbing underneath them broke at the same time. If this kind of plain English decoding helps you stay calm while everyone else is staring at red numbers, subscribe now, because the next part is where a two-day panic becomes a 12-month story. The bigger risk is not one bad week on a chart. It is what happens after companies start changing behavior. Trade taxes do not just hit prices once and vanish. They can trigger a longer rearranging of supply lines, contracts, inventories, and investment plans. That process is slow, messy, and expensive. A business cannot snap its fingers and move production from one country to another. It has to find new suppliers, test quality, rebuild shipping routes, rewrite contracts, and absorb delays. Sometimes machinery needs to change. Sometimes workers need retraining. Sometimes the alternative supplier is simply more expensive. During that transition, the company earns less or charges more, and neither choice feels good for growth. Now multiply that by thousands of firms. One factory waits on a part, another pays more for raw materials. A retailer gets squeezed by shipping costs, a builder pays more for inputs, a car becomes more expensive, a washing machine takes longer to arrive. The economy starts losing efficiency in little pieces, and those little pieces add up to slower output and hotter prices. That is where the human side returns. Consumers do not need to understand trade policy to feel it. They feel it when the monthly payment is higher. They feel it when groceries cost more and raises do not keep up. They feel it when companies stop hiring as aggressively or quietly trim expansion plans. This is how a policy headline turns into household stress. There is another twist most people miss. In a sharp panic, money often rushes into the US dollar first. That can make the dollar look strong in the short term. Global investors still see treasury markets as deep and liquid during stress. So the dollar can rise even while Wall Street is getting hit. That short-term strength can fool people into thinking the system is healthier than it really is. Because trust is not the same as a temporary dash for safety. Over longer periods, reserve currencies depend on reliability. The world holds them because the rules around them feel stable and predictable. If major policy moves start looking abrupt, hostile, or improvised, that trust can erode slowly at the edges, and slow erosion matters more than one dramatic afternoon. No, that does not mean the dollar collapses tomorrow morning. Big systems rarely break like in movies. They usually weaken through small doubts, repeated enough times to matter. A country does not lose credibility in one speech. It loses it if partners, investors, and institutions begin planning around the idea that surprise is now normal. And once that idea spreads, it changes behavior quietly but powerfully. If you care more about where this points 6 months from now than what a talking head yelled this morning, subscribe here, because the future damage in markets often starts as a small change in trust. History is full of moments when leaders tried to protect growth with blunt trade barriers. Sometimes they bought political breathing room for a season, but they also made the system less flexible and more expensive. When that happens during an already fragile period, slowdowns can become sticky instead of brief. A lot of people hear this and jump straight to disaster movies. That is not the point. This does not have to become another Great Depression to hurt badly. It only has to create an economy where inflation hangs around, growth stays soft, and policy choices keep disappointing somebody. That kind of backdrop drains energy from households, businesses, and markets. It wears people down more than one clean crash would. And once that pressure lasts long enough, the political system starts searching for relief. Voters hate high prices. They also hate weak job growth. Governments eventually feel pushed to do something big. Central banks feel pressure too, even when they pretend they operate above politics. If enough pain builds, liquidity returns to the conversation. Money gets easier, even if officials resisted it earlier. That future response is one reason hard assets still matter after a panic. Not because they are magic and never fall. Clearly, they can fall hard in a liquidity squeeze. But if the long arc bends toward more debt, more policy support, and more money created to steady the system, then assets that cannot be printed out of thin air regain importance. The short-term hit does not erase the longer-term backdrop. This is where people need to separate the storm from the climate. The storm is the forced selling, the margin calls, the panic, the need for cash. The climate is the bigger environment of debt, weaker purchasing power, policy pressure, and trust wearing down. A storm can push almost anything off course for a while, but climate decides what thrives over years. Mix those two up, and you end up buying and selling for the wrong reasons. A useful way to think about it is in three clocks. The first clock is the shock clock. That is the market hit happening now. The second is the policy clock. That is the delay while central banks and governments struggle with ugly choices. The third is the reset clock. That is when new money, new pricing, and new expectations reshape which assets lead next. Most people stare at clock one and assume the whole story is over. Usually it is just the opening chapter. So what should you watch instead of just watching the index bounce around? Watch earnings expectations, watch hiring, watch credit stress, watch whether businesses start warning about margins and costs. Watch whether the central bank sounds trapped rather than confident. Watch if the language shifts from fighting inflation at all costs to protecting growth from deeper damage. Those changes matter more than a single green day after a terrible week. They tell you which clock is ticking loudest. Also watch your own psychology, because this is where people sabotage themselves. The worst decisions often happen when the current story feels completely obvious. When everyone around you sounds certain, certainty becomes contagious. If every screen says the sky is falling, selling can feel like maturity. If every screen later says the rescue is here, buying can feel safe. Both feelings can arrive late. Smart investors and even smart observers try to ask a different question, not how do I feel about today, but what mechanism is driving this move, and how long does that mechanism last? If the move is powered by leverage being unwound, that has an ending. If it is powered by a structural shift in costs, policy, and growth, that has a much longer life. Different causes deserve different reactions. That does not mean being fearless. It means being less fooled by noise. A red screen can be a warning, but it can also be a distortion. A sharp drop can reveal real weakness, or it can expose too much borrowed money sitting on top of a valid long-term theme. Your job is not to sound brave in public. Your job is to know which kind of pain you are looking at. If you want more breakdowns that follow signals instead of political theater, subscribe now, because the next market move will matter less than the reason behind it. The crowd will keep chasing headlines, personalities, and rumors about who may back down first. But building a view on one leader's mood or one news conference is a fragile way to understand a system. Personalities can surprise you. Mechanics are colder, slower, and usually more trustworthy. That is why the deeper map matters. So step back and look at the whole picture. Trade barriers raise friction. Friction lifts costs. Higher costs pressure profits and households. That mix can leave inflation sticky while growth weakens. A trapped central bank cannot rescue markets as easily as it once did. Leverage then turns a bad move into a violent one, forcing sales even in assets people thought would protect them. And later, if pressure keeps building, the answer may still be more money. That is why the week was bigger than a scary headline. It exposed the gap between what people thought the system would do and what the system may actually be able to do. It reminded everyone that a safe haven can still fall in a scramble for cash. It showed how fast confidence can break when old assumptions stop feeling solid. And it hinted that the next phase may not be driven by fear alone, but by the painful reset of a world where growth, prices, policy, and trust are pulling against each other. The market's loudest days are not always its most honest days. Sometimes the truth is buried under forced selling, policy delay, and panic. But if you follow the mechanism instead of the mood, you can still hear it. And right now, the mechanism is saying something clear. The crash was not the whole story. It was the moment the mask slipped. And once you see the machinery underneath, you can never unsee it.